Hello and welcome to the show. I'm Kim Parlee. It is great to have you with us. There's been no shortage of events that have sent equity markets on the wild swings of late, and this higher market volatility has sparked investor interest in alternative investments that could reduce risk in their portfolio. Things like private debt, infrastructure, and commercial real estate. Now, traditionally, these assets are only available to institutional investors, but that's no longer the case. I spoke earlier with Ted Welter. He's Managing Director and Chief Investment Officer of Alternative Investments at TD Asset Management, and here is that conversation. Ted, I want to start out with a report that came out, Real Assets Quarterly from TD Asset Management, and there's a quote in it that says, global economies and markets are more exposed to external unforeseen shocks than they have been in recent years. There's been a lot going on, to say the least. How do alternatives, or what role do alternatives play in this kind of environment?
What we have to consider always is that fundamentally the alternatives is somewhat of a service provider to the broader economy. And never more than now have we been in a global economy. We have viruses, we have elections, we have different economic cycles. All those things from a top-down perspective have to be considered in all asset classes, including alternatives. But what I'm reminded with when we get into this volatility is 2008. And in a Canadian context, we saw this with shock globally of valuations. But in Canada, when you looked into the composition of the real asset space, particularly Canadian real estate, we actually didn't see a shock. We saw the expected pricing change, but underneath that, the contracted income streams that were in place, the locations of the physical buildings, were actually quite resilient in the weekly, daily, monthly volatility that unfolded. And then once things stabilized, we really started to see an appreciation of what alternatives can do in volatile and dynamic markets. So as dynamic as the world is, we have to be aware of it, but we have to hold true to our convictions of what these physical investment decisions we're making and the productivity of them and the contribution they'll make to diversified portfolios over time. So we're still quite comfortable with what the contribution alternatives are making today and what they'll do for the future.
It's a fascinating thesis to think about what happened with 2008, because when you think about some of the, these external shocks we're talking about, they're all flavors. I mean, we've got, medical ones with the coronavirus. You have, political disruption in the Middle East. You've got elections coming up in the States. So, I mean, it's really varied. And I guess to what you're saying, the alternative portfolio plays off that, but the alternative portfolio is quite varied as well.
Yeah, I mean, when we look at all those dynamics, you look at an open sea, and you can take a stock or a public equity portfolio and call that a smaller a ship that's navigating through the waves. We actually look at real estate or alternatives asset classes more of a super tanker. And we're navigating in very rough seas at times, calm waters at times, in a straight line of growth. And it takes a lot to shock that super tanker in these dynamic seas. So we're looking to be less volatile. We're looking to just continue to chug along in a smooth, growing direction over time. And that's a very interesting contribution we can make in the center against the challenged real returns of fixed incomes and the somewhat interesting but more volatile returns of the equity markets.
So in your latest report, you talk about the different asset classes in alts that you're looking at, private commercial mortgages, you look at real estate, infrastructure, and you right now say that private commercial mortgages are a high conviction investment. Why? Why does that remain that way right now?
Well, at TD Asset Management, fundamental to what we do is provide compelling solutions for our clients. One of the greatest challenges our clients have, frankly, is fixed income and the total returns that it's providing, although last year with some volatility, some interesting returns, but the prospects of returns in fixed income will be somewhat of a challenge. What mortgages do as sitting between alternatives and fixed income is it provides a compelling risk-adjusted additional return product for our clients. And the return expectations we can see from that, depending on what type of mortgages we invest in, can be from 150 basis points to 700 or 800 basis points over the equivalent bond opportunities. Why is that interesting? Because we're underwriting these mortgages against compelling Canadian real estate that has strong incomes, but additionally, we're getting the balance sheet support in a lot of instances from the owners of the real estate. So the security stack is quite compelling. When you look at the placement of the individual mortgages, you have a mortgage portfolio, and that's diversified. And that's diversified by type, by region, and risk profile. So we're able to go into conventional mortgages that are very safe, predictable, with that appropriate risk-adjusted returns. We're also able to introduce higher risk mortgages with higher returns, and together provide a diversified national mortgage solution that has compelling, predictable, and growing income characteristics to it.
After the break, I'm going to continue my conversation with Ted Welter. We just talked about mortgages. We're going to delve into real estate, commercial, industrial, multi-unit residential, some really interesting trends, and we'll talk about how that plays a role in alternative investments as well. You're watching Money Talk. We'll be right back. We've been talking with Ted Welter, Managing Director and Chief Investment Officer of Alternative Investments at TD Asset Management. He was talking about the role of alternatives as a super tanker when you think of the stability in the ocean in terms of investing right now. He now delves into real estate, and specifically the real estate sector, and some of the trends he is seeing. All right, you talked about in your report the different kinds of classes of real estate in terms of what's happening in the fourth quarter, and there's office, real estate, industrial, and multi-unit residential. Some interesting trends we're seeing in the office side. You highlight the fact that office vacancy rates are down about 11% in the fourth quarter. We're still seeing, it sounds like a fairly tight supply-demand picture in office.
It is tight in certain parts of the market. So when we look at the Canadian office market, candidly, I think we're looking at largely downtown Vancouver, downtown Toronto, and a real spark of interest in downtown Montreal. We continue to see stress in Calgary and Edmonton, and the rest of the office markets are producing to some extent as expected. But in the downtown markets, we're seeing the effects of urbanization. We're seeing the focus and the continued inertia of intellectual capital that is focusing in markets, and that's creating continued demand. So, you know, the difference between a downtown Toronto or a Calgary office market may be vacancies less than 5%. New inventory coming on, a significant amount of that inventory is either pre-leased or will be leased. And again, it's held in very stable, long-term investment hands, be it pension plans, large public corporations.
Let me ask you, we'll bring up a chart here which is showing from your report, talking about office construction. And to your point, we're seeing lots of office construction in Vancouver, in Toronto, because that's, I'm sure, where the demand is. Also, interesting trend, we're seeing that technology workers right now making up about 5% of the workforce. Is that going to shift the office market a little bit when there's more demand for that?
It is shifting it. It continues to shift it. When you look at the users being technologies related, we tend in a North American context to think about San Francisco, think about Seattle. What doesn't perhaps get talked enough about is Toronto and Vancouver. Toronto would land as number 3 in terms of technologies, demand growth of people and office space associated with that. Vancouver ranks very highly. Montreal is stimulating significant growth. And what's the correlation that's going on? Well, fundamentally, it's education. It's universities, it's urbanization, it's collaboration, it's the inertia of people and cultures that are starting to stimulate and grow. So once we embark on momentum, which we foundationally have in the Toronto's and Vancouver markets and is growing in Montreal, we anticipate a continued demand in that area, and I think that will be very healthy for the office markets in the major cities.
Let's shift to retail because interesting things happening here. I mean, we've seen store closures at Sears, Target, Forever 21. There's been a lot. At the same time, I know you've talked about there seems to be demand for, I think these are the words, unique experiential offerings beyond apparel-focused retailer. What does that mean, and what does that do for the retail market right now?
We were this morning we awakened to another closure of a retailer happening. I think what I would pronounce is that let's distinguish what we're talking about. We have a consumer, we have a retailer, and then we have a landlord. And in the context of what TD Asset Management does, we're the landlord. We're the service provider to the retailer who's serving the consumer. So when you look at how we assess the risk and opportunities there, it's been a very progressive, research-driven investigation by landlords what the real risks are. People like to talk about Sears. It's had a significant impact on vacancy in the Canadian retail market. The Sears story has been digested by sophisticated landlords for 5-7 years. We've been planning for these changes for a number of years. We're looking at existing retail environments that will be subject to significant change moving forward. So we are not off retail. We have changed the complexity or the composition of what our retail portfolio is, as I think a lot of the market is. So mixed use, urban retail is significantly important. And in our instance, super regional shopping center experiences are very important. On the super regional, though, as much as we're talking about a shopping center, we're talking about land, we're talking about location, we're talking about urbanization, we're talking about transit. So there's significant headwinds that people are digesting in retail, but think more about the landlord who has land, buildings in locations that are quite compelling, and these will re-energize and morph into lifestyle, education, health services, fashion, experiential retail. All of those things are very interesting. We're very curious about them, and we think they have a value for the portfolio moving forward.
Let me ask you about industrial, because some really interesting things going on here. I think part of it is maybe understanding what makes up industrial. It may not be what people often think, the e-commerce, logistics, those types of things as well. I want to bring up a chart as well. We've got a chart here showing, I think, availability of industrial properties by city, seeing some tightness as we are in the office market, I think, with Toronto and Vancouver. But tell me, I mean, is availability the issue? Is just where can you put these massive industrial areas, or I'm thinking, these Amazon warehouses?
Yeah, so the industrial market, again, has been preparing for quite some time for everything e-commerce. But let's not forget that industrial starts with, manufacturing, conventional distribution, moving into flex space, where you've got hybrid industrial. We also have to be cognizant of the fact in the major markets, particularly GTA, Toronto, and Vancouver, there are significant land constrictions, be it the green belt, be it water, be it infrastructure, roads, and egress. All of these things are creating challenges to new supply. Industrial vacancy rate in the major markets are effectively zero. We think that the demand will continue to outpace supply. What comes out of that is pricing stress. So we have to be very cognizant of what we're purchasing, what the covenant is, and once you purchase, where is the growth in income to support the fact you are potentially buying at a more mature stage in the cycle.
Last class of real estate for this discussion, just in terms of understanding, is multi-unit residential. And TD Asset Management has a significant holding in multi-unit residential right across Canada, and immigration playing such an important role in the attractiveness of this sector.
Immigration, top-down growth characteristics for housing are always critical. We should be very proud in Canada to have a constructive and proactive immigration policy. The the flow of immigration tends to be in the more established or major markets. So how that's affecting the housing market is incredibly low vacancy rates. I think,
and affordability, I would assume, too.
And affordability. These things go hand in hand. But I think what's really interesting about what's happened in the residential market is that institutional capital has not only recognized the value, and the value proposition is very high occupancy rates, income that can be inflation adjusted, particularly under rent control, so you have a growth avenue to it. And some of the old inventory that can be reinvested, creating new homes, safer homes for residential users, but also providing additional investment returns by doing that. We continue to be quite constructive on the role of residential in a diversified real estate portfolio. The lowest volatility, the highest predictability of returns, of income returns, comes from residential, then industrial, then office and retail. So it should be foundational to institutional investment portfolios. I think what the watch for in residential is there's a tremendous amount of attention by large Canadian pension plans and institutional investors like TD Asset Management are not only seeing the value of it, but recognizing the ESG contribution that appropriate housing for our communities can provide as the right thing to do, but also do the right and risk-adjusted investment returns for the portfolio. So I think that we can add value in residential.
All right, that was a look at the Canadian real estate sector. When we come back, we're going to take a look at the global real estate sector and also look at some opportunities in infrastructure. And a reminder, any comments or questions, we do love to hear from you. You can send them to moneytalk@td.com so we can answer them for you in the show or find the right person to answer them for you. We'll be right back. Welcome back. We've been talking about all sorts of alternative investments, the different kind of interesting classes within. Been talking with Ted Welter. He's Managing Director and Chief Investment Officer of Alternative Investments at TD Asset Management. Now we're going to talk a bit about some of the other projects they're taking a look at, things like global infrastructure as well as global real estate. And here's some things that have caught his eye. So the last classes we want to talk about in terms of alts, infrastructure, and also wouldn't mind touching on global real estate. So in infrastructure right now, I think in the past you've done a lot of investing in transportation, power generation, transmission, distribution, renewables and renewable energy. What are you seeing right now in the infrastructure market?
The first thing I would say, the infrastructure market, I think in a 9-inning game, we're in the early innings. Number one. Number two, the aggregation and the momentum of capital flows into the market is quite compelling. Number three, a lot of the aggregation of that capital is being held by investment vehicles that are writing very large checks across the world.
So it's competitive. It's
very competitive. At TD Asset Management, our global infrastructure solution is more mid-market focused. We're looking at platform investments. We are globally diversified. We're looking at, as you referred to, the 3 asset classes, but renewables continues to be quite fascinating to us. So when we look at the risk-adjusted returns that we're able to provide, we are seeing interesting opportunities, continued opportunities in Canada and the US, but in parts of Europe, and in Europe as it relates to transportation or renewables. In Sweden, we have a wind platform that we made investments in, what we call behind the meter and in front of the meter, where we have contracted income streams with company like Google, but then we also have in front of the meter, which is variable opportunities to enhance and grow income streams by selling power in the markets. Where our infrastructure program may be somewhat unique is the notion of platform investments is not buying just the Google wind power generation facility, but looking behind that and say, how do we feel about the company that's building that and operating that? Do we invest in the wind platform, or do we actually invest in the company? Why do we do that? We get the stability of the behind the meter, the contracted income streams, but we're also able to participate in all the growth that we see as incredibly attractive in wind and in renewables moving forward. And it's that platform thesis that has added tremendous value for our clients in the past, and we think is a fascinating opportunity for growth in the future.
I've only got about a minute to touch on this. I wish we had more time, but global commercial real estate. We've talked about real estate in the context of Canada in the more in-depth discussion. I mean, what are you seeing from global opportunity set? I mean, is this more opportunistic? Is it about diversification? What do you see?
We think it's about enhanced diversification. You know, when we look at our Canadian investor base, and frankly, if we look at global appeal for Canadian investment, I'd just like to touch on one point. The Canadian commercial real estate market is 2 to 3% of the global market. It's not that global investment capital isn't interested in Canada. They're fascinated by it, but the barriers of entries are so high because people and entities like TD Asset Management have such deep, large portfolio positions that they're not trading because of the value of the current income and income growth. Investing abroad allows us to expand on that diversification. The correlation between the US is actually quite high, but when you look at APAC by way of example, and investing in parts of established and transparently conducted parts of Asia, we see compelling risk-adjusted growth returns. When we look at Brexit and Britain by way of example, we've made investments in London that we think are quite compelling. We don't think London's going away. We think there's top-down noise and pressure, but the fundamentals of people living, economies growing, diversification of that is still important. So from a global perspective, we continue to see opportunities, and it's really about enhancing the opportunity to serve our client with extended investment solutions.
Ted, great insight. Thank you very much.
Thanks for having me.
That was my conversation with Ted Welter, Managing Director and Chief Investment Officer of Alternative Investments at TD Asset Management. Thank you so much for watching tonight. Any comments or questions? Again, we want to hear from you. And if you'd like to see this interview again or see anything else, you can always go to moneytalkgo.com. All the videos are there, and you can watch them at your convenience. Thanks so much for watching. Hope to see you again next week.